Let's work through the Accounting 111 final exam review. So this first question that we're going to work through, we're going to journalize some transactions, post those entries into T accounts, and then we will prepare a trial balance. So this says Emily Valley is a licensed dentist. During the first month of operation of her business, the following events and transactions occurred. So on April 1st, she invested $20,000 in her business. So this journal entry is going to include a debit to cash because our cash is going up, and a credit to owner's capital because owner's capital has to increase as well for that amount of that $20,000. Then, also on April 1st, she hired a secretary receptionist at a salary of $700 per week payable monthly. When we see that they hire an employee, that is not a business transaction. And since it's not a business transaction, no journal entry is required because this secretary receptionist has not yet worked for you at all. All they've done is gotten hired. So they haven't earned any money, they haven't done any work, so we do not need a journal entry. Now on April 2nd, you paid office rent for the month of $1,100. So we'll debit our rent expense and credit our cash for that $1,100. On April 3rd, you purchased dental supplies on account from Dazzle Company for $4,000. So we are buying supplies, so our supplies have to increase with this debit, and we purchase them on account, which means that we'll be crediting our accounts payable for this $4,000. Now on April 10th, you performed dental services and billed insurance companies $5,100. So whenever we see that we performed services, that's telling us that we're going to need to record our service revenue. And then it tells us that we billed insurance companies. So that means that we aren't getting paid right now for these services that we performed, but instead we will be paid later. And whenever people owe us money down the road, we call that accounts receivable, right? So we'll debit our accounts receivable for this $5,100 in this entry. And then we said that we need to count our service revenue. So that will be our journal entry there for April 10th. On the 11th, we received $1,000 cash advance from Leah Smith. So we're getting money now, and we will do the work later. So how are we going to journalize this one? Well, first we need to show that we're getting that money now, right? So we debit our cash. And whenever we get paid in advance of actually earning that money, actually doing the work, we call that unearned service revenue. So your unearned service revenue account is a liability. So it's increasing here with this credit, and we just toss in the 1,000 amount that we were given. Now on April 20th, we received $2,100 in cash for services performed. So we need to show that we're getting our cash. So we debit cash. And why did we get this cash? Because we performed services, right? So there's, once again, we see the terminology services performed. Just like we saw back on April 10th when we performed services, when we see those, we need to be thinking service revenue, right? So we increase our cash and we increase our revenue by this $2,100. On April 30th, we now pay that secretary receptionist that we hired back at the start of the month. So now that they've done the work and we have to pay them, now it's a transaction. So what we're going to be doing here is we're going to be debiting our salaries expense because we need to count the expense in this month. And then it tells us that we paid this employee of ours. So we'll credit our cash to show that our cash is decreasing. Now on April 30th, we also paid $2,400 to Dazzle Company for accounts payable due. So earlier in the month, we bought some stuff from Dazzle Company on account, right? And so now we are paying some of that back. So what we need to do is we need to decrease our accounts payable, because if we are paying them back, we owe them less money now. And accounts payable is a liability, and liabilities decrease with this debit. And then we credit our cash to show that we are actually paying this $2,400. So now we have all of our entries over there on the left, and we have our T accounts. So we'll go entry by entry, and we will post these entries into our T accounts. Right? So if we just take a look at the cash T account right now, you'll notice that at the top, it has your account title. And then it has two sides, right? It has the debit side over on the left and the credit side over on the right. So anytime that we debit cash, we'll put the amount that we debited cash for over on the left side of our T account. Anytime that we credit cash, we'll put the amount over on the right side of our T account. And we use these T accounts so we can figure out the balances in all of our accounts. So our first journal entry, we debited cash $20,000 and credited owner's capital $20,000. So we can throw those into the two different T accounts. And then we debited rent expense $1,100 and credited cash $1,100. Debited supplies $4,000, credited accounts payable $4,000. Debited accounts receivable $5,100, credited service revenue $5,100. Then we debited cash $1,000 and credited unearned service revenue for $1,000. Debited cash again for $2,100, credited service revenue for $2,100. Debited our salaries expense for $2,800, credited cash for $2,800. And then the last journal entry, we debited accounts payable for $2,400 and credited cash for $2,400. So now that we have all of these in our T accounts, we can figure out the balances in each account, right? So you'll notice that some just have one entry by itself, right? Accounts receivable, supplies, unearned service revenue, all those just have a single entry. So those amounts are their balances. Accounts receivables balance is a debit balance of $5,100. Salaries expense has a debit balance of $2,800, right? But it's the accounts like cash, accounts payable, and service revenue where we have multiple entries for each account. That's when we're going to need to do a little bit of math. So what we'll do here is we will take a look at our cash account by itself. We have 3 different debits and 3 different credits. Well, cash is an asset account. So those debits make your cash account increase. Those credits make your cash account decrease. So we'll add up all of the debits and subtract all of the credits, and then we'll be able to figure out the balance. So when we work through that for all of these accounts, we'll see that cash ends up with a debit balance of $16,800. Right? We add up the 3 debits and we subtract our 3 credits. Again, accounts receivable is just that $5,100. Supplies is just that $4,000. Now we get to our accounts payable. Accounts payable is a liability, and liabilities increase with credits. So we have a credit of $4,000 and a debit of $2,400. So we'll subtract those two, and we'll put the balance of that $1,600 over on the credit side. Unearned service revenue and owner's capital just had a single entry for each of those accounts. Service revenue, we get to this one and we see that it just has 2 credits, right? Well, service revenue is a revenue account, and revenues increase with credits. So we'll add those two together, and we see that service revenue has a credit balance of $7,200, and then our two expenses just had singular entries for them. So rent expense has a balance of $1,100, and salaries expense has a balance of $2,800. So now that we have all of these balances for our accounts, we can then work on the third part of this problem, that was creating our trial balance. Right? So your trial balance will have all of your accounts, and then their balances either listed in the debit column or the credit column. And then we add up our debits and credits and we make sure that they equal. Now, your accounts have to be listed in a specific order. And the order that we're going to be listing them is the order of the expanded accounting equation. So if we think back to that expanded accounting equation, that's your assets equals liabilities plus owner's capital minus owner's drawings plus revenues minus expenses. So we're going to list them in that order. And then our assets, which come first, right, have to be listed in what we call the order of liquidity. So that's how quickly we can turn that asset into cash, or how quickly we're going to use up that asset. So our first asset that we're going to list is our cash. Because cash is already cash, right? So it's the most liquid asset. And then you'll see that we put the balance of that $16,800 over in the debit column because it has a debit balance. Then accounts receivable with its balance of $5,100, supplies with its balance of $4,000. Those were our three assets that we had in this example. So then we can move on to our liabilities. We had accounts payable, which has a credit balance of $1,600. And then we had unearned service revenue, which has a credit balance of $1,000. After our liabilities comes our owner's capital. Right, so we'll list out our owner's capital and its balance of $20,000. Now, if we had owner's drawings, we would list out owner's drawings at this point. In our example here, we didn't have owner's drawings, so we can skip over our drawings and go into our revenue account that we had of $7,200. And then we have our two expenses, our salaries expense and our rent expense. So we've listed out all of our accounts in the correct order. We've put their balances under the debit side or the credit side. What we need to do now is add up our debit column and our credit column. So if you do that, each column will add up to $29,800. And we need our debits and credits to equal. So if they equal, we're good. If not, we need to go back and try and figure out where the mistake happened and fix that, and then we'll re-prepare our trial balance. Now, we prepare this trial balance so in that way we can then prepare financial statements. So we have 4 financial statements that we prepare, right? We have our income statement. That's our revenues minus our expenses to get our net income. After that, we prepare our statement of owner's equity. That's our beginning capital, adding in any investments or net income, subtracting out any owner's drawings or net loss to end up with our ending owner's capital. And then we use that ending owner's capital on our balance sheet that we prepare next. Our balance sheet shows that our assets equals our liabilities and owner's equity. And then after our balance sheet, we would prepare the statement of cash flows, right? And that one just shows where your cash came in from and where it went. So those are your 4 financial statements that you need to know about. Now, if we take a look at this next question, it's going to give us a trial balance, and we need to calculate the net income or net loss, our total assets, total liabilities, and our ending owner's capital. So there's our trial balance over on the left side. Now, we just mentioned that your net income or net loss is your revenues minus expenses. So the first step here is to figure out what are our revenues. So we have two revenue accounts. We have service revenue and we have rent revenue. Remember that the unearned rent revenue that we're given, that's a liability. So that does not get counted here with your revenues. So we add up our two revenues and we get our total revenue amount of $70,500. Then we have expenses. Well, we have three different expense accounts. We have our depreciation expense, salaries expense, and our utilities expense. You add those up and you get $78,600. So your net income or loss will be the difference. You'll notice right now that your revenues are less than your expenses. When that's the case, that means that we have a net loss. So we're going to have a net loss here of $8,100, which is just the difference between your revenues and your expenses. Now the next part wanted us to find our total assets. So when we look at the adjusted trial balance, we're given cash, accounts receivable, equipment, and accumulated depreciation on that equipment. Right? That accumulated depreciation, that is a contra asset. So that gets included here in our total asset calculation. So we have cash of $98.40, accounts receivable of $87.80, equipment of $15,900, and we are going to subtract out our accumulated depreciation on that equipment of $7,400. You do all that math and you'll find that your total assets equal $27,120. Now, total liabilities. We have two liabilities here. We have our accounts payable, and like we mentioned earlier, unearned rent revenue is also a liability. So we add those up and we get our total liabilities of $6,020. Now the last part of this question wanted us to find our ending owner's capital. There's a few different ways that we could do this here. We could take our accounting equation and we could just take the asset amount that we found and subtract out the liability amount that we found. And that would give us our amount here. But let's work through an owner's equity statement, right? So we start off with our beginning owner's capital of $45,200. If we had a net income or any investments, those would be added. But in this case, we had a net loss. So that net loss gets subtracted along with those drawings that we find over on the adjusted trial balance. So when you add together the net loss and the drawings to figure out, okay, how much am I subtracting out here in my owner's equity statement, you get that $24,100. So your ending owner's capital, we take our beginning owner's capital minus the $24,100 to get our ending owner's capital of $21,100. Now let's talk about merchandising operations. So we learned about merchandising companies and how they record different transactions, right? So this transaction here, Summer Company sold $1,000 of merchandise to Wilkes Company, FOB shipping point, terms 210 net 30. The goods costs Summer Company $650. So the journal entry from the point of view of Summer Company, they would first record the entry for the credit sale, right? That's the amount that they charged their customer. So we debit our accounts receivable for $1,000 and we credit sales revenue for $1,000. But then they also need to record the cost of that merchandise that they sold. So that's when we debit cost of goods sold $650 and credit inventory $650. because cost of goods sold is an expense account. So it's increasing here with this debit of $650. And then we also need to show that the amount of inventory that we have has decreased. So we credit our inventory for that $650 as well. Now, this FOB shipping point, what does that mean? Well, that tells you who has to pay for the shipping costs, right? So if it's FOB shipping point, that means that the transfer of ownership happens at the point of shipping. So the buyer would have to pay for shipping in that situation. The other option is FOB destination, right? And that means that it's the seller's responsibility to pay for shipping, and it's the seller's responsibility to make sure that those goods get to the destination before that transfer of ownership happens. Now, the other piece that was introduced in Chapter 5 were these terms, right? So whenever we saw terms, that replaced the terminology of on account, right? We knew that if there were terms, then that must mean that the sale or the purchase was made on account. Because what these are saying is that there's a 2% discount possible if they pay back within the first 10 days. That's what 210 means. 2% discount if they pay back within 10 days. Or they have to pay the net, they have to pay all of it within 30 days. So that tells us off the bat that, well, they must have not paid for it when that transaction first happened, right? So that's how we know it's on account. And it lets us know that there's a discount possible, right? Companies are going to be wanting to offer these discounts to be able to get their cash faster, right? They want to get payment from their customers as quickly as possible. So they're willing to dangle out there a 2% discount to their customer as an incentive for them to pay Summer Company faster. So that's what's happening there with those terms. Now, in Chapter 6, you learned about perpetual inventory systems, right? So we had 3 different cost flow methods. We had FIFO, just first in, first out. We had LIFO, last in, first out. And then we had average cost. So there's videos that I'll link in the description going through how to solve for each of these different cost flow methods, finding your cost of goods sold, finding your ending inventory. Here, I just wanted to go over the general sense of what each cost flow method offers, right? So FIFO is going to have a lower cost of goods sold, which will mean a higher net income, right? Because cost of goods sold is an expense account. LIFO is going to have a higher cost of goods sold, which off the bat it might seem bad because we're going to have a lower income amount. But if we have lower income, that means that there's lower taxes, right? So those are going to be the difference between FIFO and LIFO. And then average cost is just going to be in between FIFO and LIFO. Now, in Chapter 7, you learned about special journals, right? So we had the sales journal, we had cash receipts, cash payments, we had the purchases journal, and then if nothing fit into any of those special journals, then we just recorded things in our general journal, right? So we have a few different transactions that we're going to go through, and we need to figure out, okay, which journal would they go? So our first one is cash sales. So your first thought might be the sales journal, right? But your sales journal is only going to be sales of merchandise on account. So here, when we see the word cash, we know that it's either going to be in cash receipts or cash payments. And if we are making sales That means that we're going to be receiving cash. So cash sales would go into the cash receipts journal. Credit sale of merchandise, that's what we just talked about. That's your sales journal, right? A sale of merchandise on account. Owner withdraws cash. That means that cash is coming out of the business, right? So that's going to be a cash payments journal transaction. Then the purchase of merchandise on account. This is the definition of what goes in the purchases journal. So just like how the sales journal had to be a sale of merchandise on account, the purchases journal is the other side of that. It's the purchase of merchandise on account. Then cash purchase of land. Well, we can look at this a few different ways, right? We can look at it where cash is involved, so we know that it has to be cash receipts or cash payments. We can also look at it and eliminate the purchases journal because we are purchasing land and not merchandise. So that's what eliminates the purchases journal there. So if we are buying land with cash, that means that we have to pay the cash. So this will go into the cash payments journal. Then our last one here, equipment depreciates. So whenever we have depreciation or any other adjusting entries or closing entries or correcting entries, those are all going to go into your general journal because they just don't fit in any of the special journals. Now in Chapter 8, you learned about bank reconciliation. So a company would have a bank statement come in and they would see, okay, I have $3,560.20 on my bank statement. And then I take a look in my ledger or my T accounts and I see that I have a totally different amount. So they have to reconcile their bank statement with their books. And that's what's happening here in this bank reconciliation. So this example bank reconciliation that we have in this problem, there's mistakes, right? Terry Davidson messed up on this reconciliation. So we need to fix those mistakes. So a few of the pieces are just mixed around. The numbers all correspond with the same thing, right? The NSF check is still $490. It just needs to go in a different spot from where it is in that incorrect reconciliation that we're given. So we're going to set up our reconciliation like this. We separate it between the per bank side and the per book side. And then each side can have some things added to it and things subtracted from it. How we're going to go about this is we need to think about what doesn't this side know? So when we're working on the per bank side, we need to think, what wouldn't the bank know about? And then if it would increase our balance, we put it under the add section. If it would decrease our balance, we put it under the less section. And then we'll follow the same sort of steps on the per books side and figure out what wouldn't the company know about. So what wouldn't the bank know about here? Well, the bank is going to know about an NSF check. An NSF check is a bounced check, right? Not sufficient funds. So that's when a customer of yours writes you a check. You thought that everything was perfectly fine, that they had the money for it. Ended up that they didn't. But the bank would know because they were the one that found out that that check didn't go through. So that's not going to go on the per bank side. A bank service charge. Well, the bank definitely is going to know the amount for this bank service charge, right? They're the one charging you that $25. So that's not going to go on the per bank side. How about deposits in transit? If we think about deposits in transit like this, where you've already recorded this money that you're depositing into the bank. But that deposit is currently just on its way to the bank, right? It's one of your employees is driving that check to the bank right now. So the bank doesn't know that that deposit's coming yet. So that's something that's going to go on the per bank side of this bank reconciliation. Now we can think about, is it going to add or subtract from the balance? Well, if we make a deposit, that's going to add to the balance in your bank account, right? So we add these deposits in transit for $530. Now, outstanding checks. An outstanding check is when you wrote a check, but the person that you wrote it to hasn't taken it to the bank yet. So what needs to happen here is that we need to include it here on this bank reconciliation. Because there's no way for a bank to know that you wrote a check until the person that you wrote it to takes it and puts it into their account, right? So outstanding checks goes on the per bank side, and it's going to be subtracted out. Because if you write a check to someone, you are losing money in that situation. So now we can find our adjusted cash balance per bank, right? We take our initial cash balance per bank, the amount that was on our bank statement, we add in our deposits in transit, and we subtract out our outstanding checks, and we get an adjusted cash balance per bank of $3,360.20. Now, we move on to our per books side. So we know that there's only two adjustments that can be made based off of what we were given here, right? The NSF check and the bank service charge. Neither of those will be added to your cash balance. The bank service charge, of course not, right? Because the bank is charging you money. But this NSF check, what we have to do is we have to make this correction for wrongly recording that we had received a check, right? We initially recorded that we received $490 from a customer, but that check never went through. So we never actually got that money. So that's going to have to be subtracted out as well here on this bank reconciliation. So we don't have anything here that we're going to add. A common piece that you could see on a bank reconciliation that you'd add on the per book side would be a collection of a note, right? If the bank collected a note on your behalf, that would go under the add section for the per book side of a reconciliation. Here we don't have those, so we'll just subtract out our NSF check and then subtract out our bank service charge. Now, our adjusted cash balance per books. We take our initial cash balance per books, the amount that we had in our ledger under our cash account of $38.75.20. We subtract out our NSF check, we subtract out our bank service charge, and we get an adjusted cash balance per books of $33.60.20. And where do we see that? That's also our adjusted cash balance per bank, right? So that's why we're doing this bank reconciliation. It's because we want our adjusted cash balance per bank to equal our adjusted cash balance per books. Now, the allowance method. In Chapter 9, you learned about how companies will estimate uncollectible amounts, right? So here, one of the methods of doing that is this allowance method. It tells us that the ledger of Preston Company at the end of the year shows accounts receivable of $175,000, sales revenue of $550,000, and sales returns and allowances of $35,000. If allowance for doubtful accounts has a credit balance of $2,100 in the trial balance, journalize the adjusting entries at December 31st, assuming bad debts are expected to be 1% of net sales, and then we'll do this again, assuming that bad debts are expected to be 10% of accounts receivable. So those are our two different ways that we can estimate our uncollectibles. We can estimate either based off of a percentage of sales or a percentage of our accounts receivable. So let's first work on just this 1% of our net sales. So the first step is to find our net sales, right? So that will be our sales revenue minus our returns and allowances. So we're given those amounts up in the problem. And if we subtract them out, we can find that our net sales are $515,000. Now we take 1% of that. So we take that 515,000 times 0.01, and we see that 1% of our net sales is $5,150. So our journal entry will have a debit to bad debt expense and a credit to allowance for doubtful accounts for just that $5,150. We just take the percentage of our net sales and we throw it right into our journal entry. Now, when we are working in the percentage of receivables basis, there's one extra little step in here that we're going to need to work through. But first of all, we'll take just the 10% of our accounts receivable. So we take the 175,000 and we multiply it by 0.1 or 10%, and we see that that equals 17,500. Now, we need to make a T account for our allowance for doubtful accounts. We're told that allowance for doubtful accounts had a credit balance of 2,100. And then we want to end up with a balance of that 17,500 that we just solved for. So our adjusting entry here is for this difference, the number that would go in that red circle, right? How do we go from 2,100 to 17,500? Well, we can just subtract those two amounts and see that we need to credit allowance for doubtful accounts this 15,400. So in our journal entry, we will debit bad debt expense and credit allowance for doubtful accounts for that 15,400. So notice that the accounts in your journal entry did not change. What changed was how we solve for the amounts in those journal entries. In the percentage of sales basis, we just take the percent of our net sales and we just put that number into our journal entry. In the percentage of receivables basis, we first take the percent of our accounts receivable, and then we need to figure out how are we going to adjust this allowance for doubtful accounts to get to that balance that we want, that 17,500. Now, in chapter 11, you started learning about payroll, right? So there's a few different things that we're going to touch on here. And again, I will post more examples or links to more examples down in the description of this video. So one of the big things here in chapter 11 was the difference between gross earnings and net pay. So gross earnings is the total amount earned by the employee. Net pay is the amount received by the employee. So earnings, think of that as just the number of hours that you work times your hourly wage, right? But that's not the amount that you actually get on your paycheck. On your paycheck itself is going to be your net pay amount. So when you are recording this from the employer point of view, gross earnings, that's going to be your salaries expense, right? So the way that I always remembered that was earnings expense, right? They both start with an E. Your net pay is going to be your salaries payable. So pay is payable, right? So earnings goes into the expense account. And then we would have to credit all of our different deductions, right? And then we would also credit our salaries payable when we are recording the payroll. So remember your difference here between your gross earnings and your net pay. And to solve for your net pay, you would just take your gross earnings amount and subtract out the different deductions. So we've seen FICA taxes, we've seen federal income taxes, state income taxes, any sort of voluntary deductions, right? That's how we work our way down to the net pay amount. Now let's talk about FICA taxes a little bit here. So FICA taxes have this 7.65% rate, right? But that's broken up into two different pieces. That's broken up into the 6.2% and a 1.45%. That 6.2% is Social Security, and that has a cap on it. So people only have to pay into Social Security that 6.2% up until they make $127,200 in a year. Once they go over that threshold, they don't have to continue paying in to Social Security. Medicare, on the other hand, that 1.45% has no limit. So you could make $5 billion in a year, and every single dollar is going to be taxed, that 1.45% for Medicare. So your FICA tax rate below $127,200 in a year is 7.65%. Anything above that is just for the Medicare, it's just 1.45%.